I think that we repeat the circumstance of the decade of the 1970s, where we dealt with the debt by, in effect, devaluing the dollar. And not coincidentally, the gold price ran 30-fold in that decade. Gold moves, but the equities don't. Why is that? Well, in this one in particular, gold itself had a buyer, foreign central banks, who don't buy gold stocks. By conventional securities analysis metrics, Agnico Eagle is cheaper after the price has doubled than it was before. People say to me, yeah, but the heyday's over. The space is too competitive. The good deals have been done, which is wrong.
Okay, ladies and gentlemen, so today we have Rick Rule back on the show, and today we will talk about the US economy, commodities, precious metals, and many other very interesting topics. So Rick, thank you so much for being here.
Pleasure for being back with you. Thank you.
Thank you so much, Rick. So we have so much happening right now with the economy, with the precious metals and everything, but I would like to start with the big picture first. So what's your macro view and what's happening with the US economy, and what would be some of the things that you would be paying attention to right now?
I would say it's mixed. There's a lot of liquidity in this economy, first of all. People need to know that there's a lot of cash sloshing around in private hands. The question, although the U.S. is liquid, is the U.S. solvent? Those are very, very, very different phrases. And I would say that the economy is regional and spotty. Where I live, in the extreme northwest of the United States in Washington State, I would describe the economy as very, very, very strong. The minimum wage is not an issue here. There's a labor shortage. Uh, a Safeway has to pay unskilled workers $20 an hour to start. But other parts of the country, obviously, the circumstance is much more challenged. I think the broad state of the economy might be explained by relatively weak commodity prices. By relatively weak, I'm talking about an oil quote in the $60 level, um, despite waning supplies. And in the copper market, the copper price up only 5% when 7% of world copper production is curtailed. That tells me that in the very near term, the commodities necessary for production are in weak demand, which might suggest a weaker global economy than other numbers suggest. We certainly have a market in the US, an equities market and a debt market that can take a punch. There have been a lot of things that would cause people to be concerned about the market. The gap between short-term interest rates, which are obviously manipulated, and long-term interest rates, where the market is beginning to reassert control. Problems, cracks, if you will, in the corporate high yield or non-investment grade market. But this is both an economy and a market that I suggest, as a consequence of liquidity, can take a punch and keep on ticking. Um, this isn't one where I think the speculator wants to take undue risk. I think the underpinnings are likely fairly weak. But for now, the economy is fairly strong. I think also that some of this liquidity has to do with the continued purchase by the Fed of their own paper, which is to say some of the liquidity is artificial. And clearly, the interest rates on the near term are artificial. They, quote, were lowering them. They weren't letting the market set the interest rate. So while I think the economy is different than people say it is, I wouldn't suggest that the economy is necessarily unhealthy. What I would suggest is that people who are looking both for positive and negative confirmation are looking in the wrong place. I know that's a confusing answer. It just happens to be true.
Hmm. And if we do look at the recent economic data with all the unemployment revisions and everything, would that not suggest that we are seeing slowdown?
But it would appear over the last 10 years that adjustments, negative adjustments, have been have been the norm. I do think, as you suggest, that there is a slowdown. And as I, rather than looking at unemployment data, look simply at commodity prices, which have been, as I suggested, weaker than one would have expected. Particular copper prices. When prices are set on the margin, and we are in supply deficit, the idea that you can take 7% of world supply off the market and move prices on the margin up only 5% suggests to me that economic weakness isn't confined to the United States. It's a global concern.
Yes, that's a very good point, Rick. And if we look at the stock market valuations, what's your view on this potential disconnect between the economy and the stock market?
I don't have a view on that. Uh, by conventional metrics, as an example, the Buffett ratio, uh, equity enterprise value relative to GDP, the market is expensive. I stay out of that discussion, Vladislav, because I try to engage in discussions where I think I have a personal, durable competitive advantage. I understand valuations in natural resources and in conventional financial services, banking, insurance, wealth management, asset management. I don't understand technology. So when somebody asks me about the enterprise value or market capitalization of Microsoft or Nvidia, I have no way of knowing if they're appropriately or inappropriately valued. That isn't what I do. I'm not sure that many people do either. But the discussion as to whether the broad market is overvalued or undervalued is one that I have to absent myself from. Because although the price information is readily available to me, and macro data like Buffett uses, enterprise value or nominal market cap of the S&P 500 to GDP is available, I suggest that describing the market as undervalued or overvalued would depend on one's ability to actually accurately forecast what the net present value of future cash flows of the S&P 500 companies were. And I'm certainly in no position to do that.
Hmm. And on the US dollar, Rick, so I know you have a strong opinion on the US dollar.
I do.
And, and the US dollar has been relatively weak compared to other currencies, never mind the big picture. So have your views changed on the US dollar, or is it the same picture?
Not at all. I believe that the US dollar will lose 75% of its absolute purchasing power over the next 10 years. I don't think that the comparative weakness relative to other currencies will be long lasting. I think we're headed into a period of currency turmoil. The United States dollar has lost between 10 and 11% of its relative purchasing power against a basket of other currencies. While I think that the US dollar will lose 75% of its absolute purchasing power, I think it'll likely maintain its relative purchasing power versus other currencies. For all the sins that the United States has, it is not alone in those sins. As my friend Doug Casey says, the US dollar is the prettiest mare at the slaughterhouse, which is to say, relative to things like the euro or the yen, the yuan, the Canadian dollar, the Australian dollar, things don't look so bad. In an absolute sense, things look bad. I do think that the turbulence in currency markets will be more pronounced in the next 10 years, which is to say the movements of things like the Swiss franc versus the US dollar, the yen versus the euro, that type of thing. The changes, I think, in the next 10 years are going to be much more abrupt. There's going to be an awful lot more volatility in fiat currency denominated instruments, in sovereigns, as an example.
Yes, and I think gold is starting to show us that as well. So, Rick, gold has reached $4,000 per ounce. If we look at the fundamental reasons that moved gold to these prices, they are still here. But at the $4,000 level, what's your view on the gold market?
Uh, the rapidity with which gold has moved this year, the hockey stick chart, may not in the near term be sustainable. Remember that short term market moves are all about perception and narrative, not about fact. uh, in my lifetime, 50 years as an active investor, Gold has done well, particularly during periods of time when investors and savers are concerned about the maintenance of their purchasing power in fiat instruments, and in particular where real interest rates defined as the nominal yield relative to the deterioration in purchasing power of the underlying currency, is negative. And I would suggest that the real yield on US dollar denominated savings instruments is in fact negative. If you are one who believes that the CPI is the right denominator, you feel okay about things. With the US 10-year Treasury, you're getting paid 4.5 or 4.6% in a currency that's declining in purchasing power by 2.9%. The problem with that calculation is that I consider the CPI to be contrived. I think it's an index that bears absolutely no relationship to the purchasing power of the US dollar for the basket of goods and services that most users of the dollar experience. I believe that the deterioration in the US dollar is more like 7.5% or 8%. And I believe that that deterioration is accelerating rather than declining. If you believe, as I do, if you're getting paid 4.5 in a currency that's declining by 8, you're not making 4.5. You're losing 3.5 real every year for 10 years. What could make you more concerned about the maintenance of purchasing power than a government guarantee that you're going to lose 3.5% a year compounded for 10 years? And I think that's why gold is moving. Uh, and I believe that that deterioration accelerates. I believe that because if you look at the on-balance sheet liabilities of the U.S. government, 37 trillion or 30 trillion net of the Fed's own balance sheet, and more concerning, the off-balance sheet liabilities, the net present value of unfunded entitlement obligations at $120 trillion, that suggests that the net debt of the U.S. Commonwealth, if you will, at the federal level is $150 trillion. That number corresponds, or perhaps should be subtracted from, the Internal Revenue Service estimates of the net private wealth of Americans, which is $161 trillion. There's not a lot of margin there, $11 trillion. And it gets worse. That debt on balance sheet increases by about $2 trillion a year, a number which also appears to be increasing. While at the same time, but less well known, as the population ages, the net present value of unfunded entitlements also increases by about $2 trillion a year. Now, if you look at the delta between the private net worth of Americans, $161 trillion, and the on and off balance sheet obligations of the U.S. federal government net at $150 trillion, you have an $11 trillion delta, which seems to be disappearing at $4 trillion a year. One more statistic. The gross federal income before the federal government writes a check for anything, Mr. Trump's new ballroom, or interest on the federal debt or whatever, the gross federal income is $5 trillion a year. Compare that $5 trillion with the aggregate debt, $150 trillion, or with the accretion in on-balance sheet or off-balance sheet and off-balance sheet liabilities at $4 trillion a year, and the number gets pretty scary. My suspicion is that the only way that we deal with these liabilities and this deficit is that we reduce the purchasing power of the US dollar. The alternative to that, it seems to me, would be an honest default. Say to the bondholders, too bad, so sad, we're not going to pay you. Strong letter to follow. And saying to old folks like me, yes, you paid in for 60 years and no, you're not getting any out. I don't think that we face the prospect of an honest default. I think that we repeat the circumstance of the decade of the 1970s, where we dealt with the debt by, in effect, devaluing the dollar. In what I talk about, a 75% decline in purchasing power of the US dollar, has a prologue, the 1970s. That was the number by which the Office of Management and Budget said the US dollar's purchasing power declined. And not coincidentally, the gold price ran 30-fold in that decade. And for the record, Vladislav, I'm not suggesting that the gold price rises 30-fold from here. It's already risen 12-fold. But I'm on record as saying that I wouldn't be surprised to see the nominal price of gold, which is to say the US dollar price of gold, rise in a fashion that mirrors the decline in US dollar purchasing power.
Right. So Rick is definitely not buying US bonds. We can get that out of the way. Um, and
But I own a lot of very short-term US bonds. Let's make that clear. Despite the fact that I'm experiencing a negative yield on my short-term savings, I'm old enough to really like liquidity. And I look at the negative interest rate that I suffer as an option payment for having the liquidity to take advantage of a liquidity squeeze if there's a crisis in confidence. If a 2008 style liquidity event occurred, those people who had liquidity could take advantage of it. Those people who didn't would be taken advantage of by it. And I'm too old to want to be taken advantage of.
yes, and Rick, I would like to talk about how you navigate the gold bull market. So, with all the bullishness and the fact that the current levels are quite stretched, do you have a certain target? So how do you decide when you want to trim your positions, when you want to increase your positions?
For me, gold isn't an investment position or a speculative position. It is savings and insurance. Vlad, if a rational financial planner looked at my account, he'd say, Rick, you're out of your mind to own gold. You're the largest shareholder of Sprott. You own the brand name for gold. Your AUM will go up as the gold price increases and your fee income will go up. And that's all true. But gold enables me to sleep nights and stay calm. And for a 72-year-old, sleeping nights is very, very, very good thing. I have been systematically saving in gold. That is allocating income, whether it's active or investment income, into gold for 25 years. I would begin to liquidate my gold in the event of one of two circumstances. If I had an investment opportunity that was so compelling that I needed the liquidity, and I didn't have enough liquidity otherwise to take advantage of that opportunity, or if the reasons to own my gold disappeared, which is to say we had an interest yield on the US 10-year Treasury that exceeded my estimate of the deterioration in the purchasing power of the US dollar. Now, look at the arithmetic around that. If I suggest to you that the US dollar is deteriorating at 8% compounded, that would suggest a US 10-year Treasury yield in the 9.5 to 10 range. That would suggest a prime rate at 11 and a first mortgage rate at 12. We are a long way from there. So, in a realistic viewpoint, it is unlikely that I will be a seller of gold unless or until we have the type of liquidity squeeze that would allow me to redeploy the proceeds from the sale in a truly spectacular opportunity.
Mm-hmm. And Rick, you were very clear about the reasons to own gold, but what about silver? Why would one own?
Much less silver than I own gold. Silver, I think, is an investment or speculative asset. And that's not why I own precious metals. I don't own precious metals out of greed. I own them out of fear. So I own gold. Traditionally, precious metals bull markets are led by gold because the first buyer is the fear buyer. We've seen that in gold. The foreign central banks were the big buyers, and they were buying it because they were afraid of U.S. government hegemony, and they were afraid, too, of the declining purchasing power of the U.S. dollar. In my experience, when the narrative around gold is supported by price movement. And the generalist investor comes into the precious metal space. Leadership in the market switches from gold to silver. When the greed buyer begins to replace the fear buyer, the market action in silver suggests that we might be at that tipping point or crossing point now. I'm not smart enough to tell you whether that's true, but the silver price seems to be increasing at about twice the rate that the gold price is, which might suggest that that tipping point has been reached. Because I personally spend so much time in securities analysis, rather than speculating in silver or silver futures, I tend to invest and speculate in precious metals equities. That's the speculative class that I think I have a durable competitive advantage relative to other investors in. And in particular, rather than invest, I speculate in high quality major and junior silver stocks, the most volatile financial instruments in the natural resource market. Other people prefer to speculate in the metal itself. It has been my experience that in a real silver bull market, the high quality equities increase in price about 2.5 times the rate of increase that you experience in silver. And secondly, there is a huge dichotomy in the market between the high quality silver stocks and the low quality silver stocks. And I compete with a class of speculators that doesn't know the difference. So, I have a durable competitive advantage, which I take advantage of.
Yes, Henrik, if a few years ago someone would have told you that gold would be at 4,000 and silver would be at 50,000, would you have expected the equities to perform better than they have?
No, I wouldn't. In the beginnings of a gold bull market, particularly this one, gold moves, but the equities don't. Why is that? Well, in this one in particular, gold itself had a buyer, foreign central banks, who don't buy gold stocks. One asset, gold, which had a buyer, moved up. The other asset, which didn't have a buyer, didn't move up. The second thing is that in the early stages of a gold bull market, the increase in gold price is not well represented on the income statement of the gold mining companies. In this particular case, in 2022, when the gold price started to move, two things were happening. The first is that there was very rapid inflation in the cost of producing gold, taxes and royalties, which is to say social expense, energy costs. You'll recall that that year the energy prices doubled, labor costs. And so the operating margins of the gold mining companies didn't reflect the increase in gold prices because their costs were going up too. And then there's the unsung bogey in the gold mining industry. During periods of low gold prices, uh, gold mining companies, to maintain cash flow, often high grade. There is often a period during low gold prices where the mined grade in the course of a year is substantially in excess of the median grade over the life of the deposit. What happens when you do that is that you devalue the surrounding tons. Because you're mining lower grade, less accessible material after you've mined the eyeballs, the pockets out of the good stuff, while your unit cost per ton probably doesn't go up, your unit cost per ounce can go up a lot. After a while, in a gold bull market, you equalize that, and we've seen that. When the income statement of the senior producers began to reflect the increase in margin, that occurred late 2023, but in spades in 2024 and 2025, you see the best of the best gold mining companies rocket, which is exactly what we've seen. In a typical bull market, the momentum sequence goes bullion first, the best of the best second, the best of the rest third, the rest of the rest as opposed to best of the best fourth, the single asset producers, the junior asset producers, the developers, and the explorers. In the market that we're in, the rapidity by which money has flowed up the risk scale or down the quality scale has been dramatic. The explosion in finance availability that we've seen in the juniors in the last 3 months usually doesn't occur until 4 years into a bull market. And we've seen it occur 18 to 24 months into the equity portion of the bull market. This is extraordinary. I've never seen it before.
Mhm. Andrik, would you agree with the statement that at the current commodity price, some of the high quality producers are still relatively cheap? There's still opportunities in there?
Absolutely. Absolutely. We at the Natural Resources Investment Symposium in Boca Raton did a back of the envelope study on Agnico Eagle. We were fortunate enough to have Amar Al-Jundi, the CEO of Agnico, at the conference. And we came to understand that valuing Agnico the way I value things, the net present value of proved producing assets at today's gold price means that by conventional securities analysis metrics, Agnico Eagle is cheaper after the price has doubled than it was before. If you take free cash flow at $2,200 gold, you get one number. If you take free cash flow at $3,800 gold, you get a different number. And if you adjust the net present value at those two different gold prices versus the share price, Agnico is strangely cheaper now than it was then.
Yes, that's very, very, very interesting. And Rick, so there's this saying that hard times make strong companies, and good times make weak companies. So would that be one of the big risks as well for those who would invest in the companies right now?
I would suggest that that's probably the biggest risk if you are investing in high quality companies, that the culture changes. Uh, to demonstrate that, Vladislav, in the decade 2000 to 2010, the gold price increased sevenfold, and the net free cash flow per share of the senior producers declined. It took real skill to obviate the benefit of a sevenfold increase in the selling price of your product. Mercifully, I think for the industry, a couple things happened. The management teams that presided over that idiocy have been allowed to pursue other employment opportunities without exception. And the institutional investors and the management teams that remain, I think, are much more disciplined. I don't know how long this discipline will last. I have talked to several CEOs recently, including Amar Al-Jundi, who said that the pressure from young institutional investors to grow is very strong. It was growth, of course, or alleged growth that wrecked the industry in the year 2000. Stupid acquisitions, stupid spending decisions, a lack of cost control in the effort to goose volume. These are supposed to be businesses. And I think for the next 2 years, at least, they're going to be businesses. The M&A that you've seen this cycle is mostly strategic M&A. People haven't just gotten bigger for the point of view of getting bigger. They've gotten bigger by acquiring or merging with companies where they had operational synergy. The recent amalgamation or suggested amalgamation, as an example, between Predictive and Robex is just such a merger. Operational synergy, the combination of a great exploration culture with a great mine building and operational culture. These are intelligent mergers. They weren't entered into merely for scope.
Yes, and I keep seeing, Rick, that my portfolio gets smaller and smaller as well because companies like Silvercrest, Max Silver, they're all gone now. So
And
that's
that's going to continue. That's absolutely positively going to continue. An intelligent merger is a wonderful thing for everybody. It's wonderful for the shareholder who gets taken out at a premium. If the premium is done on a measure that's accretive on a per share basis for the buyer, over time, it's wonderful for their shareholders too. Wonderful for many reasons. Wonderful because a well constructed merger lowers the general and administrative expense relative to assets under management for the combined companies, and lowers general administrative expenses as a percentage of cash flow, which allows more money to be reinvested in the business or distributed to shareholders. It also opens up more scale for the sale of redundant assets, assets that aren't germane to the survival of the surviving company, and generates cash from assets that otherwise would not necessarily be brought to account. It allows the management team to allocate capital across a broader range of assets. In other words, capital deployment optionality, and limits the temptation of managers to spend money on a marginal project, if only to maintain their salaries over time. And then, of course, the great bugaboo: larger companies tend to have more trading liquidity, and as a consequence of that, higher share prices, and as a consequence of that, a lower cost of capital. Intelligent mergers, which accomplish those goals, are really good for everyone.
Definitely. And Rick, on the small or mid-tier royalty company, so they have performed really well, at least the ones I have been looking at. And do you still see opportunity in that sector?
I do. The royalty, and by extension, the streaming business, is a very good business. It's a business because once you've made the capital allocation decision, you're subjected to much less variability around capital costs because you don't pay them, and operating costs because you don't pay them. That is a business where, yes, you have commodity price risk, which if you want, you can hedge, and you have financial risk, which you deal with by matching your assets to your liabilities, something you can't do as well in an operating company, which is a long way of saying these are better businesses. So they're valued more highly. Because they're better businesses, they often attract better business people as managers. um, I have noticed that when I interview the senior executives of the royalty and streaming companies, even the junior ones, and I compare their competence with the median person in a similar role that I interview in other aspects of the mining business, the people who have chosen to go into the royalty and streaming business are often smarter people, which is a good thing. You have a better business model with smarter people. People say to me, yeah, but the heyday's over. The space is too competitive. The good deals have been done, which is wrong, completely wrong. We're coming into a financing cycle in the next 10 years, not merely in precious metals, but in base metals, or perhaps particularly in base metals too. And given the fact that free cash flow, particularly precious metals free cash flow, in a royalty or a stream, commands a market multiple that's much larger than that free cash flow in an operating company, but particularly in a base metals company, means that an increasingly important part of the capital stack in exploration, in mine construction, in development, in mergers and acquisitions will take place in royalty and streams. And some of the royalty and streaming transactions that I think will shock the market in the next 10 years will be the fact that the copper industry on a global basis probably requires $200 billion in capex. Copper cash flow in the market is valued at sort of 6 times, 7 times free cash flow. The cash flow from byproduct precious metal streams, silver or gold streams from copper operations, commands 12 to 15 times free cash flow. That means that the royalty and streaming company can pay enough for the stream that it dramatically lowers the copper developer's cost of capital, while at the same time generating a very economic rate of return for the royalty and streaming company. So I actually believe that the biggest transactions in the industry are ahead of us rather than behind us. And I think that those opportunities are so large that there will be everything that Franco and Wheaton and Royal and Osisko and Triple Flag can swallow, plus enough to syndicate. to the smaller guys. I mean, I think you're going to see billion-dollar transactions, $2 billion transactions, which means that there's going to be plenty for everybody. On the other hand, I think there's going to be a lot of transactions in the 10 million, 20 million, 30 million, $50 million range, which increasingly is too small of a bite for the Francos and the Wheatons of the world. It doesn't matter. It's not worth spending their time and attention on. So I think that the royalty and streaming space, from the very biggest down to at least the smallest that are well run, that are viable, uh, is going to be a very good business. In fact, I have assisted a few private investors in assembling natural resource portfolios that were entirely constructed from royalty and streaming companies that had no operating or development or exploration companies in them at all.
Yes, that's very, very interesting. And Rick, just in relation to the copper market. So as you have mentioned, the fundamentals look really, really good. But in the current uncertain economic situation, would the prices be low enough for you to buy and not even look at the economy?
Sure. I mean, I ex I don't expect. I'm afraid that we're going to experience a synchronized economic slowdown, which is a fancy way of saying a recession. And I'm afraid that that might mute copper demand. I have absolutely no doubt that we're going to have supply declines in the copper business over the next 5 years because we have underinvested for 30 years, and you can't make that up quickly. But if you have declining demand, you can have declining supply without having a price increase. But I really don't care what I think in the near term. um, I if I can find a reasonably priced tier one deposit in any commodity, tier one to me being sort of $10 billion in situ recoverable reserves and resources at today's commodity price, where the mine would be in the best quartile worldwide in terms of all-in sustaining costs, best quartile, and where the return on capital employed would be in the best quartile worldwide, but at least 25%. I will buy that, irrespective of my outlook for the economy and commodity prices. When I was a younger man and had less time on Earth, or more time on Earth, pardon me, Vladislav, I was strangely impatient. When I was a 25-year-old, I wanted stuff to happen in 3 months. At 72, I'm much more patient, although I have less time on Earth. It isn't because my time preference is different. It's because I've learned that my time preference doesn't matter. It takes 5 years or 6 years at least for compounding to work, and compounding is how you make money. Buffett said he avoids losing money by thinking, but he makes his money by sitting. And I have learned that that is true for me too. So I've come to understand that I have no idea what the copper price is going to be like in a year. But I believe in 5 years, it's going to be at least nominally dramatically higher than it is today. Um, and so the consequence of that is that given that I don't know what the price is going to be a year from now, I kind of don't care. Let's say that I buy a share of a copper mining company that I think is fair value today at $10. And I buy it early and it falls to $7. And then it goes to $40 or $50 5 years out. I think you get your point. You get my point, pardon me. You expose yourself to a 30% decline. And that exposure, if you know enough about the investment and have the courage of your convictions, exposes yourself to a 4 or 5 fold gain. A circumstance where I have a high quality company, and if you juxtapose my upside to my downside as being 30 to 50% on the downside, juxtaposed to 500% on the upside, if I can afford to take the risk, is a wonderful juxtaposition of risk to reward. And I think people who define their investment goals more specifically than that, given how little they can actually know, are lying to themselves. And I don't want lying to myself to be one of my investment risks.
Right, right. And Rick, on the uranium market, so do you see any changes, macro changes, or is it the same picture? The fundamental look very bullish, but short term, we don't know what's going to happen.
Lots of changes. I think the smaller equities are short-term overbought. I don't know. The easiest money to be made in the juniors, Vladislav, is buying stuff when it's hated, when it's truly hated. And the uranium juniors were pathologically cheap because they were hated. And I bought, mercifully, a lot of them. The easy money is made when it progresses from being hated to liked. Doesn't need to be loved, but liked. So we've done that, okay? And a lot of the stuff that I bought when it was hated, I've sold it because it's no longer hated. My reason to buy it disappeared, so the stock had to disappear. But my core positions haven't changed at all. The stubborn supply response or lack of supply response to incentive pricing changing from $40 a pound to $80 a pound tells you a lot about what you need to know about the price elasticity of supply, at least over time. We've seen a doubling of the uranium price and no particular move in terms of either production or production decisions. At the same time, I suspect that escalation in construction costs is going to be much steeper than people think, which is to say a $6 billion capital expenditure, something that's slated to be a $6 billion investment in 2025 will actually become a $7.5 billion investment in 2026 and will grow at 10 or 12% compounded over time. That means the value of existing producing assets that don't need to be either permitted or financed is much higher than people think it is. Much higher than people think it is. The other thing I see in the uranium business that people don't pay attention to is the security of price and sales afforded by long-term contracts. There's no commodity that I know of on the planet where producers, no other commodity than uranium, where producers can contract with investment grade counterparties and specify the price and terms within references that they receive for their product over 20 years. As this market matures, what it does is it allows banks and lenders such as myself or securities analysts such as myself to get a much better approximation of the net present value of future cash flows because you know the price. And that will lower the cost of capital for the uranium industry. When I buy a gold mining company, there's a development stage, and I think they're going to build the mine in 4 years, begin to sell the product in 5 years, 6 years, 7 years, and I try and do a net present value calculation, I have no idea what that product is going to sell for. None. I have a theory, I have an opinion, but the banks wisely don't take my opinion as collateral. In the uranium business, the thing is very different. Somebody goes to put a uranium mine in production and they can sell, let's say, 60% of their production at specified prices for up to 20 years, or at least long enough in enough volume to amortize the loan. That means a couple things. First of all, it means the loan is available to them. In earlier times, junior uranium companies that didn't have investment grade balance sheets probably couldn't get the production financing. They had to sell the deposit to somebody like Cameco who could build it. Now, they may choose to sell it to Cameco, but they can pre-sell production to China General Nuclear, Tokyo Electric Power, Southern companies, Duke Power, and they can take that investment grade obligation literally to the bank. Now, when they do that, ironically, they piss off speculators because they've limited the price upside on the pounds that they've sold. I'm old enough, Vladislav, that if you take away all or most of my downside, I'll give up some of my upside. I'm fine with that transaction.
Yes, and there are very few high quality producers in that sector as well, which is very interesting.
There used to be two, and now I think there's one. There's enough doubt around Kazatomprom, both in terms of the internal politics in Kazakhstan as it relates to uranium. I'm attracted to Kazakhstan, by the way, as a destination. But more particularly, their restart difficulties at Inkai and other places, and more particularly, the degree to which the middle managers, the very high quality young Kazakhs who were employed by the firm, who 5 years ago I was so impressed with, a distressing number of those people have left the employ of Kazatomprom. The consequence of that is that I've sold my stock. When something's going wrong that I don't understand, I sell. So it seems to me that the only investment grade alternative in the uranium space as a company is Cameco. I consider the Sprott Physical Uranium Trust to be an investment grade asset in the product, but not a producing asset.
Yes, Andrik, just before we wrap up, I would assume you're very interested in natural gas and oil at the current levels.
Particularly interested. I like hate. And the conventional energy business is probably the most hated space in the commodity sphere. I believe that the finest energy company that I know of in the world, Exxon, is selling at a 50% discount to what it's worth. And I believe that it's what it's worth probably doubles, but maybe triples in the 2 to 5 year time frame. I can't make any price projections, but the idea that I can sell, that I can buy the finest company in the space on the planet at a 75% discount to what I think it'll be worth 4 or 5 years from now is extremely attractive to me. All oil has to do is go from hated to neutral. And across the board, market capitalizations double. By the way, despite the fact that the US oil and gas industry is cheap, the Canadian industry, if you have the tolerance for the political risk being that the central government of Canada, the Laurentian elite, doesn't like the country's best industry. If you're willing to talk yourself through that and suggest that economics win over politics over time, the Canadian industry is selling at a discount to the US industry, and the US industry is selling at a discount to net present value. So, yes, I love the oil industry. And from a speculator's point of view, I'm actually more attracted to the Canadian industry than the US industry.
Yes, makes total sense. So Rick, these are all the questions I had. Is there anything else that maybe you would like to mention? Maybe you have a boot camp coming up or anything?
Well, thank you for the opportunity to give a commercial. If people like the way I think, which is to say contrarian, value-oriented, counter-cyclical investing in resources, they can personalize it. If they go to my website, ruralinvestmentmedia.com, and list their natural resource stocks, sidebar, no crypto, no pot stocks, no tech stocks, just natural resource stocks, I personally will rank them and comment on individual issues if I think my comments might have value. There's no charge for this service, no obligation. It's totally free. If you like that, you can join 15,000 other people at the Rural Classroom, where there's something like 230 hours of instructional programming and free Q&A every Thursday. At least every Thursday I'm in town. That's ruralclassroom.com. Again, absolutely positively free. If you want more, every 90 days we do a boot camp. We take one topic. We spend 8 hours on it with a panel of experts. We go deep, deep, deep into the topic. That's $99. $99 gives you 8 hours, and it gives you access to the recordings, which you'll need because we give you more information in 8 hours than you can absorb. It gives you access to the recordings for a year. By the way, that comes with a no questions asked money back guarantee. If you don't think that you got your $99 worth over 8 hours, we'll give you your $99 back. And then finally, once a year, we put on what I believe is the world's finest natural resources investment symposium. Whether you attend live or online, you get 46 or 47 hours of programming in 4 days, more than you can absorb. But again, you get access to the recordings, which you'll need for a year. Whether you attend live, which I would prefer, or online, which is more convenient for most people, again, you have a gold-plated money-back guarantee. When I say money-back guarantee, in 40 years of offering a guarantee, we've had to refund less than 1/10 of 1% of the tuitions that we've charged. But the fact that that guarantee is in place means that you're fairly assured that as a customer, you're going to be more than happy with the product offered. So, Rule Investment Media for rankings, Rule Classroom for free instructional programming and interviews, the Rule Bootcamps for deep dives. The one that's coming up is on the Golden Triangle in northern BC. And then the granddaddy of all the products, the Rural Natural Resources Investment Symposium in July, either in Boca Raton, Florida, or from the comfort and convenience of your own home via live stream.
Yes, I had used all of these services. I have visited the symposium online this year as well, and I highly, highly recommend it. I will have all the links in the description below. So Rick, thank you so much for your time. I really enjoyed the conversation, and I'm looking to have you back on the show.
My pleasure, sir. I look forward to an invitation, which I will happily accept.